Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 25th of June. I'm Daniel Lam, your host for the podcast. During the weekend, I went to the briefing sessions of one of the best primary schools in my district because my son is coming up to the application age. There, I saw many stressed out faces of worried parents. They were somewhat relieved when the deputy headmistress talked about the strategies for primary school application, especially about having diversified options in order to be able to react to different scenarios. Now, it's a bit similar in investment. We are overweight equities, but we have allocations to other asset classes as well for diversity. Now, today I want to talk about fixed income. So despite having a core holding or neutral view, there are pockets of opportunities in global bonds. Now, history tells us that US dollar bond yields generally peak not far from when the Fed stops hiking rates and fall near or ahead of Fed rate cuts. Now, the magnitude of this decline varies depending upon the size of rate cuts, but history argues for locking in today's yield. Holding a core allocation to bonds is attractive, especially versus holding cash, where reinvestment risk is considerably higher as rate cuts bring future yields lower. Now, how are the different sub-asset classes looking right now? Well, first of all, we are staying neutral developed market investment-grade government bonds. We see fair risk-reward of US government bonds as rate cut expectations by both financial markets and the Fed dot plot are now aligned to our own expectation of a single 25 basis point cut this year. We see the US 10-year government bond yield staying within the 4.25 to 4.5% range for the next 3 months, followed by 4% to 4.25% over the next 12 months. We also see limited value in developed market investment grade and high yield corporate bonds because the yield premiums remain at the tighter end of historical averages. Now, the interesting areas lie in the EM bonds. We are overweight EM US dollar denominated government bonds, as we believe the relatively high yield and better value mean it is likely to outperform global bonds. On the other hand, we are underweight EM local currency bonds, as we believe the yield does not compensate for taking on currency risk. Many major EMs are also unlikely to be cutting rates as deeply or as rapidly as developed market central banks that limit price gains in EM local currency bonds. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.